Hello friends, welcome to Proficient Group. Uh, it is 19th of May 2018, Saturday, and myself, Shumay Pushami. Welcome to our weekly webinars that we conduct every Saturday on behalf of Proficient Group. Alternately, every week we present a webinar rather. Today, the topic of today's discussion is momentum oscillators. I will briefly give you some introduction about what are the momentum oscillators and why we need them for our trading purpose. And then I will give you some examples of various momentum indicators that we generally use in our trading. And in fact, one thing is for sure that there are very different kind of momentum oscillators, right? Hundreds or more than that momentum oscillators are available right now. If you go to Metastock and click this drop down menu, then this big list, the big list contains some kind of different momentum oscillators or momentum indicators, but all of them are not equally important, and we cannot use all of them in our trading purpose. Every momentum indicator has its own purpose, and also they have their own strength and weaknesses. We need to know about their strengths and weaknesses so that we can take advantage of their strengths, and we can nullify their weaknesses through some other techniques, right? So let's begin today's session about the discussion on momentum oscillators. And now, momentum, the term momentum is a generic term, right? Now, what do we mean by a generic term? Generic term means that is a term that encapsulates all a huge array of indicators. Like I can say, for example, the word fruits, right? Fruits. By this term, the fruits, we mean a huge different types of fruits like mango, orange, grapes. All these are fruits. Like in the same way, when we are telling about momentum oscillators, there are very different kinds of momentum oscillators, and all of them are given, have been placed under the broader chapter of momentum oscillators, like RSI, which is the relative strength index, like ROC, rate of change, like stochastic, like MACD, moving average convergence divergence, like MACD histogram, like ADX. So all these are various momentum oscillators, right? And what is the very purpose of momentum oscillators? The very purpose of momentum oscillators is to find out the latent strength or weakness in prices, right? These strengths or weaknesses may not always be visible if we only look at the price alone, right? But somewhere down the line, when the rate of, suppose there is an uptrend, right? Suppose there is an uptrend, but the rate of increase is falling. So that will give us a signal that the bulls may not be as strong as they're looking. But looking only at the price, it is not possible to find that out. Say, for example, here we have a daily chart of Nifty, right? I can draw an upward trending line here, right? This is an upward trending line. Now, looking at that upward trending line, there is no way to speculate or no way to suspect that there was some sort of weakness last week, right? Looking at the price, we cannot see that. We cannot tell that because prices have been making higher top, higher bottom formation uh, since the last week of March. Now, when there was a weakness, before that weakness, we saw that one particular momentum oscillator, like this ROC, I have plotted here 22-day ROC. I will explain what is 22-day ROC, what do we mean by all these terms. We can see that this 22-day ROC, rate of change oscillator, was actually not making any new high. Here you can see, right? All the prices was making new high, but the ROC oscillator was not making any new high. So this was a symbol of weakness, right? This means that prices are increasing, right? But the increment in price was not because coming or influx of new buyers. It was simply because of the inertia of the past uptrend, and this inertia is very likely to stop. So this is something we call negative divergence. When prices are making new highs, but momentum oscillator, here we are using momentum oscillator of ROC, rate of change, it was not making new high consistently. So this is called a negative divergence, right? In the same way, you can see here that here from the January top to the March low, prices were making new lower top and lower bottom, right? Prices were making new lower tops and lower bottoms. Here is a bottom, and here is another bottom. But look at the momentum oscillator. The momentum oscillator was actually not making any new bottom, right? This was a bottom, and this was another bottom. So here we see that although prices were making lower bottoms, and if we only look at the price, then we will quite confidently say that prices are in a downtrend, but the picture was actually changing and the bulls were actually losing their steam, but this was not visible from the price chart alone, and that insight we can get from the momentum oscillators. If we look at the corresponding diagrams of the momentum oscillator, here ROC, you will see that although prices were making new low, but the ROC was actually not making a new low. It was in fact making a higher low. So we could have said there that the downtrend was probably ending, and this will get further confirmation when this downward trend line in price will be violated, right? So this is the very purpose of momentum oscillator, that we can see the inherent strength and weakness in price, which is normally not visible to naked eye if we only look at the price alone, right? And this kind of divergence, I will take this issue up later in one of our later webinars. I will tell you that divergence is an excellent signal in trading, although not all divergences are equally strong, and divergences also sometimes fail. So you have to use your money management strategy all times. But divergence give a very good trading opportunity, and they are a strong signal. But that is towards the latter part, or sometimes we will discuss this topic in one of our later webinars. Today, I would like to start one of my very favorite oscillators, momentum oscillators rather, which is called MACD, moving average, convergence, divergence, right? Now, there are two kinds of oscillators. Some oscillators are bound to move between 0 and 100, right? But some oscillators are actually not bound. They can attain any value. They do not have any boundary like 0 and 100. MACD is one such oscillator which keeps oscillating about the zero line. As you can see, the horizontal line in the momentum oscillator. This horizontal line is the zero line, and MACD keeps oscillating about this line, and it gives us signals, right? So MACD is a very important momentum oscillator, which is actually derived from moving averages, right? Moving averages are itself derived from prices. So these MACD is nothing but a derivative of price. In fact, all the momentum oscillators that we create and that we will be talking about are nothing but a derivation of price. Prices are manipulated in various ways to create some sense, to create a sense of direction, to create a sense of strength or weakness of the bulls and bears, to help us to get the likely direction of the market, right? So MACD is again one such oscillator, and this indicator is derived from two moving averages, which is 12 and 26-day exponential moving averages, right? One is 12 and the other is 26. The MACD is actually calculated as the difference between the 12 and the 26-day moving average. Here I have plotted 12-day moving average in blue and the 26-day moving average in red, so that when the blue moving average is actually above the red moving average, I am making it in simple moving average terms. Yeah. When the blue moving average, which is the short-term 12-day moving average, is actually crossing over the red moving average, the longer-term 26-day moving average, the MACD becomes positive. And this is the region when you can see that the MACD is becoming positive here, right? So MACD is nothing but the difference of these two moving averages, the 12 and 26-day moving averages. And by doing this, we are creating a momentum oscillator, because in an uptrend, the short-term moving average tends to be higher, tends to be placed above the longer-term moving average. And in a downtrend, the short-term moving average tends to be placed below the longer-term moving averages. So in a downtrend, MACD will be negative. MACD, the value of MACD will be less than 0 in a downtrend, when the short-term moving average is residing below the longer-term moving averages, and vice versa. In an uptrend, MACD will be positive. Now, the red line in the upper pen is actually the MACD line, one of a very important momentum oscillator that we can use in our trading. And we also have a dotted line in blue, and this dotted line is actually the, or I should keep it in dot rather. So this dotted line is actually a derivative of the MACD line, right? This dotted line is actually the 9-day exponential moving average of the MACD line itself. So it is nothing but we are trying to make the MACD line more smooth. And the crossover between the MACD line and the signal line, the dotted line we sometimes call as a signal line or trigger line. And when this crossover is occurring, we can get signal here, right? Okay. So this is how MACD is constructed. MACD stands for moving average convergence divergence, and this is how the MACD is constructed. And what kind of signal do we get from the MACD line? Now, there are 3 kinds of signals that we can get from MACD lines. First is a normal crossover between the MACD line and its trigger line, which is the red MACD line and its blue trigger line. And when these crossovers are occurring, we are getting a signal here, right? Suppose this is a bearish crossover signal, so we are getting a sell signal here. Suppose this is a bullish crossover signal, so we are getting a bull up buy signal here. And suppose there is a sell signal here, suppose there is a buy signal here. So whenever these crossovers are occurring, and I'm telling you, these crossovers occur every now and then, right? So I do not consider these crossovers to be very strong signals, except in certain conditions, and I'm going to explain when these crossovers are more meaningful and when these crossovers are less meaningful, right? But the first thing is that we get a signal of buying or selling depending upon if the MACD line is crossing over the signal line. For a bullish crossover signal between the MACD line and the trigger line, we get a buy signal, and for a bearish crossover we get a sell signal. Now here it is important to consider not all signals are equally important, right? Not all the crossover signals are equally important. If we can discriminate between these signals, then we can basically eliminate many wrong signals, many wrong trading signals, and our trading can be improved by a large margin, right? The common sense is that the common sense tells us if the crossovers occur, suppose this is a crossover, suppose this is a crossover, and this is also a crossover, right? The common sense tells us that if the crossovers are occurring away from the 0 line, right? Away from the 0 line, then they are more significant, right? I will also like to see cell signal much above the zero line. Say for example, this cell signal that occurred here is more strong than a cell signal here, right? I'm giving, I'm trying to show you this with two vertical lines. Suppose these two were two different cell signals, and I do not consider these two cell signals to be equally important, because the first signal, which occurred in fourth week of November, thus this cell signal, this occurred very close to the zero line. Okay, so there was a fair amount of chance that this cell signal could be a false one. On the other hand, this cell signal occurred much above the zero line. So what I mean here is that there is enough opportunity for the price to fall to a very low level and the MACD to come at a very low level, right? So this cell signal is more important than this cell signal. It is needless to mention that if we get a cell signal here, right? If we get a cell signal here, or if we get a cell signal here, these cell signals are not, I do not consider these cell signals to be strong enough. Forget about what happened to the price. Prices were in a downtrend and they continue to come down. But these cell signals occurred much below the zero line in a negative territory. So I do not consider these cell signals to be important at all. I will prefer to see a cell signal much above the zero line, that is the positive territory. By doing so, I am ensuring that that there is a large enough space for the price to fall down, right? Now you can also say that in the similar fashion, I will prefer to see buy signals much below the zero line. So you can say that this is a buy signal in MACD. Yes, I accept this is a buy signal in MACD. This is also a buy signal in MACD, and this one is also a buy signal in MACD, right? Here we are doing some important improvisations, and these kind of improvisations are not mentioned in textbooks. So whatever I'm telling you, I'm telling you from my own experience, and I suggest you to pay close attention to this, because you may get your trading ideas from here. Now we got three buy signals in this region, right? And the first buy signal occurred in the first week of March, the second one in second or third week of March, and the third and final one was in the first week of April. Now, I will suggest you to create some sort of neutral zones, right? Suppose 100, I am establishing 100, positive 100 for the MACD to generate a sell signal. I will take a sell signal that is a pair, that is a bearish crossover between MACD and its signal line only above, only if the value of MACD stays above this line, right? And in the same manner, I will prefer to use a sell signal, suppose at around -70, which means I will not take any buy signals if it is not generated below the level of -70, right? Why this discrimination? Why I am taking a higher value for a sell signal to be generated, a higher value of MACD, And why I'm taking a lower value is because stocks or the index or the market in general shows a positive tendency. It has a tendency to go higher. So sell signals should be more should be we should look for a more stringent condition to generate a sell signal, right? And that's why I'm using a higher value of MACD. I'm telling this zone, the plus 100 to minus 70 for Nifty only, because this value changes according to the value of the underlying stock. Since we are talking about Nifty, we are talking in absolute terms, and this value of MACD will be different for different stocks. So whatever I am telling you is specific for the Nifty index alone, right? So for Nifty, I generally use a plus 100 value for a sell signal to be generated. That is, I will consider any sell signal only if the crossover occurs above the plus 100 level, right? And I will accept a buy signal only if the buy signal is generated below the minus 70 level. Now here is another point to consider, that these levels should be taken as a certain percentage of Nifty and not also in absolute terms of Nifty, not also in absolute terms, because the value of Nifty also keeps changing, right? Today the value is 10,600. A year ago, the value was 8,000. 5 years ago, the value was 5,000 in Nifty. So, as the value of Nifty keeps changing, these levels also should change, and you have to consider these changes, right? You cannot take the values to be stagnant forever. You have to do always some back testing and adjust these values accordingly. Now, if we set the value of the lower level for MACD to be minus 70, then this first buy signal is actually eliminated. I am not taking this buy signal here because this buy signal was generated above the level of minus 70. The second buy signal was actually, there is a little bit of confusion here, but let us be safe. Let us assume this is a valid buy signal. So if we are buying it here, then we will have to keep a stop loss, and this stop loss we can put in absolute terms or some certain percentage terms of Nifty. At best 1 or 2 weeks of low, and which will be stopped out here. So if we buy it here, so it will be stopped out here. But very important thing is that if you assume that, if you create a rule that you shall never buy in Nifty, you shall never take a buy position in Nifty if it stays below a certain moving average, like 26 or 30-day moving average, then you can also eliminate quite a lot of whips of signals like this. So here, what I mean is here that if you take although there was a signal here in MACD, but the prices actually did not go above this moving average. So there is another reason to pass off this trade, so bypass this trade. But let us assume, to be on the safe side, that you took this trade and this trade was stopped out. Now, the third signal occurred here, right? When the third signal actually, buy signal actually occurred much below the minus 70 level, and if you are buying it here, then well, this is a profitable signal. You are getting a decent amount of profit here, but I will suggest to buy above this 26 or 30-day moving average to ensure that prices are really showing some strength, and by doing this you are also eliminating the previous losing trend. So this is my first take about the MACD signals, right? The crossover of the MSD line and the signal line will give you the first idea that a trend reversal or an opportunity of a new trade is coming. But here again, I will suggest you to use a neutral region. You will take a valid sell signal only if MACD stays above this value, and you will take a buy signal only if MACD stays below that value. By doing this, I can assure you that by doing this, you can eliminate a hell lot of bad signals, right? A hell lot of whipsaws. And what are the major disadvantages of moving average? The major disadvantage of moving average is that they keep give us whipsaw signals during a choppy trend. When there is no trend, it keeps us giving buy signals, sell signals, and all those things. But if you employ this kind of strategy, then you will be able to eliminate all these whipsaw signals, because these whipsaws occur only in the vicinity of the zero level. Any signal that are coming in the vicinity of zero level has a greater potential to be a false signal, right? So this is the first kind of signal from MACD that you can get. I told you there are three kinds of signals. Now I am coming to the second kind of signal, and which is quite strong. And this is the change of territory of MACD line. If MACD line actually crosses the zero line and it comes below, right, as it did here, right? This means an inherent strength of weakness, an inherent weakness, right? This can be taken as onset of a bear market, right? That is, if MACD goes below the zero line. But again, stocks do have some tendency of going up in the long term. So MACD sell signals are less reliable than MACD buy signals, and the MACD actually has a tendency to stay above the zero value for a larger period of time, as you can see from this chart alone. And that means when MACD crosses above the zero line, the buy signal is very, very reliable, and the buy signals are stronger. And also you can see there are many crossovers between the MACD line and the signal line, but there are not as many crossover signals between the MACD and the zero line. So these MACD and the zero line crossovers are comparatively lesser in number, so they are more reliable, so they are occurring less frequently. Say for example, this zero line crossover of MACD, like from here to here. Okay, so in this period, MACD actually stayed below the zero line. So this will actually be taken as a sell signal, but this is not a very reliable sell signal, at least as long as it whenever prices go above the 30-day or 26-day moving averages, the sell signal becomes nullified. But whatever be the case, if you take the sell signal, then you also have to take the buy signal here, right? This buy signal gives a whole lot of profit, and it compensates many more times than the stop loss that was generated here. So MACD buy signals are more reliable than MACD sell signals, at least from the point of view of the crossover of the zero line. Here I am showing you another example. MACD actually generates a sell signal by going below the zero line here, but prices do not continue the downtrend and quickly goes over the 26-day or 30-day moving average here, and the next buy signal we are getting here, right? And this buy signal gives us a a very big profit, right? And this buy signal is also generated by the MACD going above the zero line. So I'm reiterating my statement that MACD crossing the zero line is also a very strong signal, and MACD buy signals tend to be stronger than the MACD sell signals, and you have to use these MACD signals in conjunction or in combination with certain moving averages. If there is an MACD sell signal but prices go above that moving average, you have to exit from a short position. In the same way, if MACD gives a buy signal but prices go below a certain moving average, you cannot hold your buy position for long enough, right? So you have to use your risk management strategy along with the signals of MACD. So that was the second kind of signal that we can get from MACD. Now we are coming to the third kind of signal, which is a sort of divergence. And I told you that a divergence is something that shows the inherent strength or weakness in prices, right? Say, for example, to the right of the chart here, I'm showing you two tops in prices here on the last week of April and here on the second week of May. Now look at these two prices and look at the corresponding chart of MACD. Prices have made a new high here, but MACD has refused to make a new high. So this shows an inherent weakness in price. Only by looking at the price, you cannot tell that prices are showing any sort of weakness, because prices are really making new highs. So there is no point of suspicion that there could be some reversal at hand. So this kind of signal will tell you that prices are rising, but this rise in price may not be because of the coming of a new set of buyers, but because of the momentum of the previous uptrend, and this momentum is very likely to win out soon. The confirmation will come once prices closes below the last bottom, that is the series of higher bottoms is terminated, or an important moving average crossover is broken. And with this, I can give you a quick analysis of the market condition here. This comes back to back with the whatever I told you about the nature of the MACD signal. As you see, there is a sell signal from MACD. MACD generated a sell signal, although it is below the level of 100 that we mentioned right now. But nevertheless, it was a sell signal, and this low of 10,600 was actually broken yesterday. Not only that, prices also broke the 26-day exponential moving average. So there is some inherent weakness true in prices. And what does the weekly chart say? Yeah, I'll draw your attention to the weekly chart of Nifty as well. Prices, this kind of candle are, that is the last week's high or the last week's open was actually above or at the same level to the previous week's close, but last week's close was actually below the previous week's low. So this is actually entirely covering the previous week's candle, and this is a sort of bearish candle formation. I will tell more about it when we will learn about the candlestick formation. So I'm not giving you the details of this particular formation. This has certain name, right? Uh, but nevertheless, there is a high possibility that prices have already made an intermediate top, and we are expecting lower prices ahead in Nifty because of certain price candlestick formations, right? And I think you have enjoyed the MACD part, whatever I have told you, and you will use this conception of MACD, and you will also try to improvise it with your new ideas. Most important thing is you have to use different levels or different values of MACD for different stocks, right? If and whatever I'm talking is true about the levels, the crossover levels. You cannot take all the crossover levels. The crossovers should be significantly away from the zero line, and this much of distance should be different from different stocks, and you have to do it from your own discretion, and you will have to do it from your own backtest. So here we go. You have to use this conception in your own trading. I think you will like it. And we are concluding this session today. And this particular video will be uploaded to YouTube as well. You can post your queries there, and I'll be delighted to reply you. So thank you, friends. Goodbye, and see you next week.